Good afternoon. This is Ask Marie again. And today I'm going to do part 2 of how to get a mortgage. And talk about some different kinds of mortgages. The three that I think I'd talk about this time is going to be the FHA mortgage. That stands for Federal Housing Administration. You can get a fixed mortgage. Now, to get a fixed mortgage means that your mortgage can't really move up or down because the secondary mortgages cannot move in and buy your mortgage. It's fixed. So that's what most people are more comfortable with. Then you have VA, Veterans Administration. That's generally for the military people. Nothing down. So they like it. And it's guaranteed and backed up by the government, of course. And then there's conventional. Now, conventional is the mortgage that will take 20% down, even if you don't have a job, but you do have income. Their biggest concern is debt to income ratio. They want to make sure that you can make payments, but with 20% down, they've gotten 20% of your money already, and they don't have to have a PMI, principal mortgage insurance, because with FHA, you do have to have a PMI where the mortgage is insured in case something happens where you can't pay for the mortgage. The mortgage company needs to know that they are insured. Now, of the three, if you don't qualify for Veterans Administration VA mortgage, or you don't qualify for conventional, then you might look at FHA. Most of the time, it's 3% down. Now, the interest that they charge you is they have criteria, and this is what impacts the interest rate. The size of your down payment. Let's say the house is $100,000. 3% would be $3,000, but you might want to put $5,000. That will reduce your interest rate. So your monthly payments would be a little less than they normally would be. The size of the down payment and your credit score. And I talked to you earlier in part 1 about how to get a decent credit score. Of course, that is by paying your bills on time, all of your bills on time. Don't just send half a payment in. That is not a payment. Now, if they're asking for $30 a month and you send $50, that's good favor. But if you send $25, you did not make the payment. That company can charge you late charge fees. That's unnecessary money spent on paying late charge fees. Wise people just don't pay late charge fees, So now, like I said, conventional, they are concerned about your debt to income. So if you put 20% down, again, we're thinking in terms of $100,000, and you put $20,000 down, and you don't have any more money, that is a concern for them. And then you don't have a good score, that is also a concern for them, and you can't blame them. But a lot of people try to do that. They don't have any income, they're not working, but they put that 20% down to get into the house. Well, it's a matter of time. The bank will have the house back. Now, one mortgage in particular that I didn't mention was a balloon mortgage. A balloon mortgage, it starts out with small payments, and you're counting on getting a raise on your job. It starts out with small payments, and it states in the paperwork that on a certain date up the road, you have to pay the total balance of the mortgage. If you can't do it, you lose your house. So all those years that you've been paying low payments, you can't sell the house because it's a balloon payment. Nobody wants to transfer a balloon payment and take on the responsibility that you have. So you can't transfer the loan. So at the end of the balloon period, if you don't have that money, you lose the house. You got to move out and they resell it. Now they know that if you're living there, most people are going to fix up the house or something, or add a room, or renovate the garage and the shed and things. So there's going to be some improvements. That all goes back to the mortgage company. So you might want to stay away from balloon payments. Now, I hope that I've been of some help to some people, and as well as others, in reference to these mortgages, different types of mortgages. FHA fix is what I find more feasible, because they can't sell your mortgage to another mortgage company. It's fixed, and even if they did, it can't go up, probably, or down. Of course, we wouldn't mind if it went down. There's also buy downs that you can do when you apply for your mortgage. You could put the $3,000 down on a $100,000 house and use the other $2,000 to buy down the interest rate. And that way your mortgage payments, monthly payments, would be lower. But like I said, I hope that you've benefited from this video and gained information, and stay, subscribe to the, because I have more videos coming about these mortgages and finances, and you might be interested. So have a blessed day, and do subscribe.